2 weeks ago, there were numerous bearish divergences present. Once again, the bears did not take advantage of it. Over the last 2 weeks, the charts have been hinting that the divergences would be resolved in a bullish manner, and that's exactly what happened after Friday's employment report. In this video, we'll look at the S&P 500's bullish trend and a simple way to stay with that trend during 2013 thus far. We'll look at numerous risk-on versus risk-off charts in terms of the short-term resolution favoring the bulls. Technology stocks are clearly trying to make a bullish turn, and we'll show that on 2 charts. And the bearish divergences that have been in place since late January seem to be clearing in the bulls' favor. We have been experiencing what's known as an outlier scenario, where you have bearish divergences in place on many risk-on, risk-off charts, and the S&P 500 continued to rise. It's important that your models account for outliers. They can happen again. So we've taken a look at our correlations and our weightings. We'll cover that briefly, showing you some Excel spreadsheets. We'll talk about the divergences giving us downside protection, where maybe we were under-allocated during a 6% gain. But we'll talk about bear markets and how our models protect against the losses. Investors tend to make the same mistakes over and over again, and they seem to be gravitating back towards buy and hold. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Our models provide downside protection against catastrophic losses like this one that occurred during the dot-com bust. As markets tend to rise over time, in terms of where we are now, the longer and longer they rise without a bear market, the more and more investors believe in buy and hold. And wow, do we think that the S&P 500 is about to drop 51%? No, we don't. We don't want to be fear-mongers. We don't believe that at all. We don't believe the conditions are in place right now for something like this to unfold. A lot of things would have to change. They may change. But the point is, people make the same mistakes over and over and over again. And now investors are getting to a point where buy and hold starts to look appealing. Well, our models can protect against the inevitable bear market. Another bear market is coming, and another 50% loss is coming. The question is when? Will it come in 3 months, 3 years, 6 years, 7 years? We don't know. But missing or being under-allocated, I'd rather be under-allocated for a 6% rise in the S&P 500 when we had a lot of non-confirmations like we've had since late January of 2013, than be over-allocated during a 51% loss during a bear market. And if you're moving into buy and hold territory, I'm going to put some money in the market and park it. You have to ask yourself, do I have any rules or conditions or models in place to protect me from the next 50% plus loss that inevitably will occur in the stock market? Again, don't want to be a fearmonger. Don't believe that that type of loss is around the corner. Just as another sobering reminder of what bear markets look like, it's been a long time since the low in March of 2009. People forget that the S&P 500 gave back years' worth of gains and fell from 1576 in October of 2007, and it dropped intraday all the way down to 666, a 58% loss. So would I rather be over-allocated during a 58% loss? Or would I rather be under-allocated during a 6% gain? Our models, it will be so clear and is so clear. These are easy when you get into these bear markets. The proof is in the pudding. In the fourth quarter of 2008, we were in 100% cash. It was obvious that the odds were against you. In fact, it was obvious that the odds had turned in Q1 of 2008. Later in this video, we'll talk about an outlier event in terms of what's happened with the recent advance, in that it wasn't confirmed by the credit markets or small caps. There were a lot of divergences there. An outlier is something that happens infrequently, but it can happen again. And therefore, you can adjust your models for outliers. And we've built over the last few weeks, been putting in a lot of long hours, a corollary model. You can maybe call this the CCM correlation model, where we have some additional rules that we've added. If you get these outlier scenarios where the S&P 500 advances and you don't get confirmation from an SPX, stocks versus bonds, small caps versus bonds, etc. And what we did is we went out and we looked at long-term correlations. So if you're concerned about how the S&P 500 zigs and zags, obviously the S&P 500 has a correlation of 1 relative to the S&P 500. It's a perfect correlation. So in terms of your weightings for your rules and for this corollary model, the S&P 500 is the most important thing to watch. And as you move down this list, they get lower and lower weights and become less important. So for example, monitoring small caps is important relative to tracking where the S&P 500 may go, but it's not nearly as important as these items up here that are more purely based on price. So for instance, long versus shorts is price. This is price. Long versus shorts, price. Long versus shorts, price. This is the one exception that correlates very well, is stocks versus bonds and the aggregate bond market, long versus shorts, and all of these are useful. What you can do too is when you look at the S&P 500, here are some of the rules that we've built. You can also notice the first questions are based on price, because price is the most important thing. The most important thing are price, those moving averages, and are we trending up, or are we trending down? Everything else is secondary. So you can also take each individual chart that you look at and overweight questions that are more important. So this price rising is much more important than rate of change rising, and you can reflect that in your models. And you can see we've built really a whole new model over the last 2 or 3 weeks. This goes way, way down, does a lot of programming based on this, and you're asking questions about several indicators and just getting an idea of how bullish is this market, how bearish is this market, and it's heavily weighted on trend following and price. This is a weekly chart of the S&P 500 index as of the close on Friday, May 3rd. This is the S&P 500, the dotted line. The blue line is the 3-week exponential moving average, and the red line is the 5-week exponential moving average. Purpose of showing this, first of all, this looks bullish and has looked bullish during all of 2013. Notice during the majority of this advance, blue stays above red, price is above both moving averages, and the slope of all three, or the trend, for the most part during this advance is up. The inverse is true here. Price goes below the moving averages, and eventually you get a clear moving average crossover here, and after that point the market is weak. Bullish, crossover, bearish, bullish crossover, bullish results. Does this work perfectly? No, you don't need it to work perfectly, and your objective is not to curve fit these numbers. You just want to use moving averages that are reasonable. In fact, when you build models, you're better off not going back and curve fitting and finding the exact combination that's perfect. Why can you get away with using something that's not perfect? Well, you have redundancy in your models. And again, want to emphasize that if you're overweighting the S&P 500 in your models and changing some of your weights, you'll notice that this signal worked extremely well during this period. this outlier period that will show you that the stock market didn't act as it has in the past, but that's irrelevant. There's upside here to catch, and we want to catch it, and thus we made some changes to our models. If we scroll down here, you'll notice this is a peak in red, a bottom in green, a peak, a bottom. Some other indicators or rules that you can use to help out. Again, this is S&P 500 weekly. You'll notice weekly CCI. Good things tend to happen when CCI is overbought or over the 100 level here. So we're overbought, S&P 500 does well. Overbought, S&P 500 does well. This comes after the peak here, but there's no significant give back until you move out of overbought territory. Overbought in 2013 here, good things happen. So in our models, we increase the weights of numerous indicator levels, such as CCI, increasing the chances of staying with these outlier trends. Coming down here, let's look at stochastic RSI, similar situation. Overbought, good things happen. Overbought, good things happen. Overbought, good things happen. Williams %R, similar setup. Overbought, good things. Overbought, good things tend to happen. Overbought, good things tend to happen. One more comment before we leave this chart. In fairness to the models and in fairness to traders that have had a little bit of a rough time catching this portion of the trend, this is a weekly chart, so therefore it only shows you what the chart looks like as of the close on Friday. Intra-week, this chart has looked worse. We had a couple points in here where intra-week you actually did get a bearish moving average crossover, I believe on April 18th, at least in some of the crossovers that we used. We did get a crossover as of Thursday, but Friday the stock market went up. And you can see on a closing basis, there's never a clear bearish crossover that takes place here. So what do you do with that? Well, in your models, you basically say, if I'm going to make moves intra-week, they have to be smaller and incremental moves because I don't know how the chart is going to look at the end of the week. If you're a CCM client, a fair question may be, Chris, you saw all these things that looked like the market was going to roll over. Why did we enter the Friday morning of the employment report with a clearly net long position with no hedges on the short side of the market? And the answer is things changed. And heading into the employment report and why we've been scaling up our longs over the past few weeks is the setups that we had that looked bearish didn't convert from a setup to actuality. And here's one chart that tended to lean in a bullish manner heading into the employment report. This is HDGE. It's basically a short ETF. So here we're looking at shorts relative to longs. You can see when the S&P 500 rolled over here, the ratio of short to longs was already catching a bid and already was making a bullish turn. Here, stock market corrects. The ratio is already making higher lows and higher highs and looking bullish. That's not what we had last week. Last week, heading into the employment report, this looked really nothing like this. This still favors bullish outcomes. It's possible this is the most significant chart that we will cover this week. This is a chart that we've looked at for some time. This is the S&P 500, or the SPY ETF up here in the left-hand corner, relative to IEF, or intermediate term Treasuries. So this is risk on relative to risk off. When the ratio rises, that's what risk on looks like. You'll see the S&P 500 does well. When the ratio falls, tends to be a yellow flag, and that's what risk off looks like. What we've been watching is when the ratio of stocks to bonds stalled in this area and this pink line acted as resistance, it was a yellow flag, and eventually the stock market corrected in a sharp manner. Here, you've got a line that acts as resistance for the ratio. Yellow flag, stock market peaks. Resistance for the ratio, yellow flag, stock market peaks and rolls over. This is the end of January here, and if I go across, you'll notice up until last week, so 2 weeks ago, this ratio had basically gone nowhere. And there was a battle taking place here between risk on and risk off, with no clear winner in terms of a strong trend. Now, I will note, the trend here is still favoring bullish outcomes. Your moving averages are in a bullish situation. Everything stayed bullish. It looked like we might roll over here. In fairness to our models or anyone that uses similar models, while this still looks bullish, this is on a weekly closing basis, intra-week, so on a Wednesday or a Tuesday, this chart was on shaky footing and these moving averages looking like they were going to roll over. And you can't see that now in some instances because if the market closed on a bullish note on a Thursday or a Friday, the chart quote-unquote repaired itself and looks a lot better. Net bottom line, it appears we have a bullish breakout, a relatively convincing bullish breakout in favor of the stock bulls relative to bonds. Can we get a head fake here? Sure, breakouts can always give you a head fake, but you can't assume that it's going to be a head fake. You have to respect price here. You can see resistance, resistance, stall, 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 stall. This is a clear move favoring the bulls, and as long as this chart looks like this, we will favor stocks over bonds, but we'll head into next week with an open mind. Some other things that took place last week that leaned towards the bullish end of the spectrum and leaned towards the bullish end of the spectrum even prior to Friday's employment report. This is QQQ, or tech stocks, relative to the S&P 500. When the ratio rises, tech stocks are in greater demand relative to the S&P 500, and when the ratio falls, tech stocks are out of favor. You can see when you get a bullish breakout here, bullish moving average crossovers, this blue above red, price above that, slopes up, tends to be, from a probability perspective, a good time to be in tech stocks. Bad time to be overweighted tech. Breakout, good time, bad time, good time, bad time, good time. You can see here tech stocks have been out of favor for a long time, which tends to be, all things being equal, you'd prefer to have technology lead. It's not a must for the S&P 500, but you're better off. Healthier markets tend to see tech lead relative to the general market. It's obvious that last week we had a bullish breakout to the upside, and we're trying to get a moving average crossover here. So price is above, the slopes of the moving averages are turning up. This looks like a fairly attractive setup from a probabilistic standpoint. Is it possible that you get a short run higher or a reversal? Sure, it's possible. But we'll respect price here, and now it appears that tech has a higher probability of leading now rather than lagging as it was here. This is a longer term chart of the same ratio we just looked at. This is QQQ relative to the S&P 500 weekly, going back all the way to 2008. You can see here this line acted as resistance and tech stocks underperformed. Bullish breakout here, came back and retested it. It's common to retest, so it's possible that we go up here even if this is a bullish move and come back and retest. As you can see here, you don't always retest. Sometimes you just have a little bit of a stall and then you push higher. Breakout acted as support here on a retest. So support, resistance, support again. Tech stocks did well. It appears as if it's acting as support in this general area again as we turn up. A turn near support, all things being equal, is a good thing and probably increases the probability, with the emphasis on the word probability, that we get something that looks similar to this, where tech outperforms relative to the S&P 500 index. Just taking a little bit closer look here at a risk-on versus risk-off chart. This is the S&P 500 relative to the aggregate or diversified bond market ETF AGG. You can see going back really all the way till late January, you've got somewhat of an indecisive move, and then you get one sharp leg up here at the end of February. And then from March, really all the way until last week, there's a battle going on between stocks and bonds with no clear winner in here. So in terms of taking on a lot of risk in this box, you don't really know which way this is going to break. On a closing basis, notice the 3 and 5 week exponential moving averages always tended to side with the bulls. The however is, this is very, very shaky here. You're very, very close to getting price below the slope of the 2 moving averages going down, and we almost got a bearish crossover. Same thing here. Shaky situation. Price below, slope of these down. You actually can see the blue is a little bit below the red here in mid-April. So this chart was looking very, very shaky and indecisive until last week when we get a clear breakout. Breakouts don't always hold, but you really need price to do something negative to offset this clearly bullish move here. Typically, it's a good sign when these moving averages start to fan out like this and you get white space in here. As it sits now, this chart favors bullish outcomes for risk assets and favors stocks. Could it change next week? Sure it could, but until it does, it favors the bulls. If you only watch these weekly videos and you're not following along on Twitter, it might be a good idea to do that. Why? Well, we've tweeted over the last few weeks several charts that were saying things seem to be leaning towards the bullish rather than bearish end of the spectrum. We tweeted this chart several times during the week prior to Friday's employment report, saying that it seemed to be leaning towards the bullish end of the spectrum. This is risk off relative to risk on, AGG, divided by the stock market. This tells you that bonds are in favor here, here, and here, which is what risk off looks like. When bonds are in favor, the stock market tends to consolidate and roll over. Bonds in favor, stock market consolidates and rolls over. You'll notice here, bullish moving average crossover, slopes up, price above. Bullish moving average crossover, slopes turn up way down here, price above here. Stock market corrects, stock market corrects. You can see last week, never had that. It looked like this moving average was trying to turn up, looked like this one was trying to flatten out. But this chart last week, during the entire week, favored the bulls and was leaning towards a bullish employment report, and it turned out to be helpful. This is another chart that we've covered for several weeks, and it's a chart that, like many, had kind of a rollover look to it, but it never rolled over. This is the S&P 500 index, risk on relative to the VIX or Fear Index, risk off. This is what risk on looks like. You can see typically when the ratio rises, that's pure risk on. Stock market has a tendency to do well. Ratio rolls over and falls below the orange line here, stocks do poorly. Ratio begins to fall, making a series of lower highs, breaks the orange line, stocks tend to do poorly. You can see we've had a very indecisive market recently, and it's still indecisive. This is still making a series of lower highs. So this chart really isn't out of the woods. However, orange line you can draw here, attach this low to this low is the blue line, which I've added. You can see this still appears to be acting as support. As long as we remain in the upper half of these trend channels here, it tends to favor bullish outcomes. Blue is now above red over here last week, and price is above. Here's a chart, one of a handful that we'll show in this video, that show the outlier situation with this advance in the S&P 500 with no rollover here. This is junk bonds, or riskier bonds relative to conservative bonds, long-term U.S. Treasuries. So we're looking at the ratio of risk on, JNK, relative to TLT, risk off. When the ratio rises, stocks have a tendency to do well. Ratio rises, stocks do well. Ratio rises, stocks have a tendency to do well. Conversely, when the credit markets start to get nervous, ratio peaks here before the stock market, ratio rolls over. This is a worried look in the credit markets. Stock market corrects. Credit markets look worried. Stock market eventually corrects. You can see credit markets have been worried. And look when the worry really begins. If you think about it, it really goes back to almost the entire calendar year. There's been no clear bullish trend here. You get this one breakout and a reversal. This here looks like this period here and this period here, where eventually stocks corrected. In this outlier scenario, the credit markets corrected. TLT outperformed JNK as this is falling. But in this instance, the stock market did not correct. Does that mean that JNK relative to TLT is useless and we should throw it away? Absolutely not. It's very useful. What it does mean is you may want to change your weights in your models, how this is weighted relative to things like the S&P 500 or the NASDAQ that are based purely on price. We also have bullish looks here with our moving averages in price. Price last week moved above the moving averages, and blue, while this is rounded, appears like it's not above, but if you get in close here, blue is actually above red. This here looks like this period here where the stock market began an advance, and looks similar to this period here where the stock market advanced, or here advanced. Here we get the bullish crosses, stocks do well. So as of Friday's close on May 3rd, this is favoring bullish outcomes. Could we get a short-term move like this? Sure we could. Anything's possible, but right now this favors stocks over bonds, and it favors risky bonds over conservative bonds until something changes here. Here's another outlier chart. This is just small caps in isolation. Very, very similar to the last chart we looked at. Risk on, risk on. When small caps are doing well, the stock market has a higher probability of advancing. Conversely, when small caps are weak and start to roll over from a trend perspective, that tends to be negative for the general stock market. Small caps, bearish look to them here. Bearish look to them here as far as our moving averages. Stock market corrects. Here you can see going back all the way really until it starts to somewhat hesitate right after this breakout. So for a good portion of this advance here, small caps have not confirmed the move. This is a bearish look in small caps, a bearish look in small caps. This is telling you to be careful. This here looks similar to this period here and here where stocks corrected. You can see last week, in terms of the divergences, this is a divergence. Price is rising on the S&P 500. This is not confirming it. Something had to fall in line. Either this, the S&P 500, had to roll over to look more like these periods, or small caps had to pick up the pace to come in line with this. It appears that the divergences on all these charts are being cleared up in a bullish manner, at least as of the way we sit on Friday, May 3rd. Price above, moving averages above. Again, does it mean that following small caps or the relative performance of small caps is a waste of time? Absolutely not. It's very useful going forward. We've cut back on our weights relative to this, so something like this is weighted quite a bit less than anything that we would see purely on the S&P 500 index. Another divergence here. Now we're looking at small caps relative to the TLT. So this is risk on stocks, relative risk off conservative bonds. Aggressive stocks, small caps, relative to conservative bonds is a good indicator of market sentiment. Don't have to go through all these arrows. It's the same as the previous charts. This is risk off, this is risk off, this is risk on. We had a divergence. You can see here for most of 2013, we have not had a confirmation of this move higher. In fact, this looks very, very bearish here. Last week, like a lot of the other charts, was resolved, at least as of Friday's close, in a bullish manner. As long as this chart looks like this, stocks will be in favor relative to bonds from a probabilistic perspective. Exact same concepts from the previous charts. Now we're looking at S&P 500 relative to TLT, so stocks relative to bonds. You can see here going back all the way until late February, and even here in late January, this looks tentative. You get one sharp move higher, and immediately it starts to look tentative again. This is a very, very tentative look going all the way back to late January. Here, you've got the divergence like the other charts, and like the other charts last week, especially after Friday's employment report and the reaction to it, which is much more important than the report itself, this one appears to be resolving in a bullish manner as well. As long as this looks like this, we will favor stocks over bonds, but we'll keep an open mind heading into next week. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.